Good morning, good afternoon, good evening, everyone, and welcome back to the breakfast show. We've got a lot to talk about today. We've got an Amazon Openai potential investment. We've got more news on the Netflix, Warner Brothers, and Paramount deal. We have some more comments on where the market might or might not go in 2026. Hut 8 got a big deal from Anthropic, so that's pushing up the majority of the neo clouds this fine morning. The market seemed to be a bit greener than yesterday. We also have, we'll have a look at a couple of comments from some Fed people. Right now we are seeing some movements, but not much regarding the potential for a government shutdown. So we'll have a look at that. We're going to have a look at the probability of a rate cut in January. It's actually lower than yesterday. But first up, good morning, everyone, or good afternoon, good evening. Welcome. Hello, chat. Hope you're all having a wonderful day so far. Now, if we go and have a look at the current speculation prediction of a government shutdown at the end of January, still sits at 38%. As you can see, over the past week, we did have yesterday a small jump after the ACA enhanced subsidy. The vote did not happen, so I assume that's why we've seen a jump. But since then, it went back down to around a 38% chance of a government shutdown by the end of January. Then, looking at the probabilities of a rate cut, 25 basis points rate cut in January, that's actually lower than yesterday. We're sitting at 22.1%. My background is uglier now. I mean, I've got some others to try out, so pretty sure it will only get better from here for you if this one's ugly. Only get better from here. So 22.1% chance of a rate cut in January. And then if we look at the March meeting, we are sitting a bit higher than yesterday, 44.9%. So a bit higher, but probably it's still in a 50-50 limbo right now for rate cuts in March, not in January. Then looking at the pre-market at the moment, we are, of course, if we look at the neo clouds, we have Hut 8, that's up 22%. We'll have a look at that news. Cypher is up 3, Nebus is up 2.8, Applied Digital up 2.5, White Fiber 1.5, Iron 1.4, and CoreWeave is still the ugly duckling here, is still down 0.7% this morning. As for fintech, we have Nu that's down 2%. All the rest is currently green. Chip stocks are mostly green. Nvidia is down 0.3, ASML 0.1, all the rest is green at the moment. As for the big tech companies, we have Netflix that's up 1.5%, then Amazon 1.2, Google 0.2, the rest same thing. Tesla and Oracle are down a little bit this morning. No, I don't have a green screen, so this is purely Nvidia's doing, which, let's be honest, shouldn't really be that much to ask for. In 2025, you don't need a green screen to replace a background. As long as the lighting is good enough, I think the AI should understand. Then, some of the bigger news, I would say that maybe impacts some of the players in the AI field. We've got one. Blue Owl will not back a $10 billion deal for an Oracle data center. So more pressure on Oracle here. So either, because that's also something interesting. Hut 8 is up 22% right now. Apparently yesterday, before 30 minutes before the close, huge volume, huge buying action for Hut 8. Someone always knows something. Now with Blue Owl here not backing a 10 billion deal for an Oracle data center, maybe that's why we've seen the continued pressure on Oracle. Maybe, maybe not, but it's not the greatest headline, let's say, for Oracle. Yesterday was that Robinhood event. I found one of my comments on an older Robinhood post when they announced their yes and no event. I said probably prediction gambling markets are going to be announced and expand, and that was exactly the yes and no type of thing. Great business. I just don't think you should mix gambling with investing, but it's great for the business because they'll be making quite a lot of money from that. Then let's go to the Hut 8 news, if I can find it. Or maybe no. Maybe let's start with Amazon. So Amazon is in talks to invest $10 billion in Openai. Remember, it wasn't that long ago that Openai said they are going to invest $38 billion in Amazon. So here again, you have that same type of circle of revenue, right? You have Openai saying that they're going to invest $38 billion into Amazon. And now we have Amazon, which is looking apparently to invest $10 billion into Openai. But at the moment, the talks are fluid, so nothing has been announced. Amazon's funding could value Openai at over $500 billion. Talks underline Openai's ability to partner widely after restructuring. I think that's also one of the reasons why Amazon is up at the moment, not by much, but at least, where is it? It's up 1.1% right now. That's it. Do we have more info on that? Probably they're going to use Tranium, I assume, because otherwise, why would you invest that much money? Let's see if that report has anything to tell us. It's the information. So the information has been misinforming us quite a lot over the last couple of weeks, but in this case, they say Openai plans to use Amazon's Tranium chips, which competes with NVIDIA and Google chips, and add that Amazon's financing could lead to a broader fundraising round with other investors. Openai is looking to sell an enterprise version of ChatGPT to Amazon, but it is unclear whether the deal includes provisions for integrating ChatGPT features such as shopping features that Amazon is developing for its own apps, because Amazon has been doing things themselves. I believe it's called Rufus. Let's see if it's Rufus AI. Yeah. So Rufus AI is Amazon's AI-powered shopping assistant integrated into the mobile app and website. Maybe Amazon feels that their AI is not as good as what they thought it would be, so maybe integrating ChatGPT would make it better. It's possible. But for now, these are just talks at the moment. Then another report, and in this case, not from Amazon, but from Google Waymo. Waymo is in talks for $15 billion funding at near $100 billion valuation. Now, the question here that I see a lot of people asking is, why would they do this? Why would Waymo, which is again owned by Google, raise $15 billion? By the way, this funding round is led by Alphabet themselves. But if Google has so much cash, why wouldn't Google just straight up fund this business? Why would it allow outside investors to fund the business? That's the question that I've seen. Peter, you asked the question. I'm already one step ahead. My thinking here would be that they treat this as, again, one of their bets, one of a standalone company, because Waymo has its own co-CEOs, right? And so it makes sense to use outside capital to fund this. I still believe that in the early 2030s, we are going to see Waymo being a publicly traded company. That was my prediction, still is my prediction, and I think that's why they're willing to raise money from the outside, while probably still being by far the majority shareholder. But it's still a money-losing business, right? Waymo is still a money-losing business. I believe I've seen an annualized run rate of close to $400 million right now, growing quite rapidly. But yeah, to me, this is just one way for them probably to just grow faster. I do also think that we're just going to see Waymo license the tech to other companies. So the cost will just be these other companies, whether it's Hyundai or another car maker, they make the car, Waymo license the tech goes into the car. And so these arguments that said, oh, Waymo cost $200,000 for Waymo. No, the costs are probably going to be split between a Waymo and the company that makes the car, because Waymo is just licensing the tech. And then you're going to have a lot of companies with autonomous fleets. And we go back to my own thesis of Uber, is that all of them would like to be listed on Uber because that's where you get the best distribution and the higher utilization. The more utilization, the quicker you'll get your return on investment. That's it. So this is the Waymo news. Not surprised, happy to see this. And Google is, well, flat right now on the report, but then again, it's been going quite high. And now we might maybe bottom here around $300 or so. Another pretty big deal, and this is something that we talked about yesterday or 2 days ago, can't remember, one of the two. So that's about Databricks. So remember we talked about, to me the news is positive. I don't think you can see this as negative. As long as Waymo grows faster and faster, it's a positive thing for me. Remember we talked about Databricks, we talked about Anthropic, SpaceX, OpenAI, me wanting to see in my What happened here? I am back, I think. Did I leave? I'm back. I think I am back. Anyways, we had, but I froze, I know. I mean, my screen was black. I am back. Okay, perfect. It's my, it's Zscaler. So, Databricks, this is basically what they've been doing. Over 55% year-over-year growth, over $4.8 billion revenue run rate. They raised over $4 billion in Series L. Series L. What kind of greedy something are these people? Like Series L? Seriously? Just go public already. What the heck is this? A Series L. $134 billion valuation, over $1 billion in data warehousing revenue run rate, and over a 140% net retention rate. It's time for this company to go public. Like Series L, what are you going to do the whole alphabet? This is crazy. It's time for them to go public, but at least we got some numbers here. Of course, we like to compare Databricks, Snowflake to a ClickHouse, right? Which Nebius does own a decent stake in. If Databricks is worth $134 billion, how much might a ClickHouse be worth? Well, it remains to be seen, because I'd like to see the numbers from ClickHouse, and then you can maybe start to make a comparison and see how much Nebius' stake in that company is going to be, and you basically add that to your own valuation of Nebius. But I think 26, 27 is when we're going to see quite a lot of bigger companies go public. Now, with that said, we actually have Databricks CEO that commented on going public.
Well, cloud data platform Databricks, number 3 on this year's CNBC Disruptor 50 list, turning heads as a new fundraise values the company at $134 billion. That's nearly double the $75 billion public market cap of Snowflake, one of its biggest rivals. Joining me now on a first on CNBC interview, Databricks co-founder and CEO Ali Ghodsi. Ali, welcome. Big numbers here. We've been talking about IPO possibilities for Databricks for a long time, but let's talk about revenue. You're right up against a $5 billion revenue run rate, growing at 55%. Could you still do that if you were public?
Yeah, I think so right now. But I think if the question was, if we had gone public in 2021 and stayed, public in 2022 when everything was going, down and, interest rates were going up, then I don't think we would have been at this growth rate right now.
Well, I mean, is that a reference to Snowflake? Because they went public right around then.
Many companies, but yeah, they were one of them. But there are many companies that ended up in that situation. So that allowed us to invest in, agents. It allowed us to do the database acquisition of Neon. So we have Lakebase. So, we would not have been able to do those.
How do you think your free cash flow compares? We do have a number for that in Snowflake, but we don't have it for Databricks. Talk to me about your cash management strategy, how that factors into your raise here and your vision for the future.
Yeah, so, we've said that over the last 12 months, we've been free cash flow positive. So, we're efficient business. But we're reinvesting it. We're not trying to produce lots of free cash flow. We just want to stay at this break even and invest it back in agents, in databases, Lakebase. There's this new category of applications out there that are being built. We call them data intelligent applications. We want to invest in that.
A lot of times companies will go public in part so that people feel like they're stable, they're enduring, they're in for the long term. Companies already know your name, clearly, by this growth. And right now, the market is at a place with data, with AI, where some are questioning if valuations are a little on the high side. How much does that factor into your choice of whether you go public in 2026?
Yeah, I mean, look, we will be public. I wouldn't rule out that we wouldn't be public next year, so I wouldn't rule that out. But, I don't want to also take the company public and then 2022 happens and then the market wants to have 30% EBITDA and, we can't invest in these. I mean, there's a huge secular shift happening. Like, no matter what happens with this AI, whether it's a bubble or not, people are not going to stop using AI. For instance, software engineers are not going to stop using AI for software engineering. This trend will continue. All that software that they wrote before is now cheaper to write. All that software needs a database that works well with the agents. That's what Lakebase is about. All of them will be building these applications. So I would hate it if the market forces us not to be able to invest in these growth areas and these innovations.
So how would...
Already twice or 3 times he says the same excuse. We would like to go public, but it would be a shame if we have another 2022. 2022 happened after after the huge pandemic spike where everything was overvalued and we went from 0% interest rates to, extremely high interest rates. So very unlikely that 2022 is going to happen. But why does he keep using the excuse of, we go public, but it would be a shame if the market suddenly demands, 30% margins or whatever, EBITDA margin or EBIT, one of the two, there's a difference. And we will not be able to invest. Man, if your company is good, then you're going to do well 2022 or not. Like 2022, stocks went down, but the good companies were good companies. They continued to grow. I don't know, something strange here with the way he's saying we would like to go public, but we are trying to time. Basically, they're trying to time the market. They want to go public when the market goes up. So they, of course, will get a much higher valuation. They, of course, will cash out and probably pull the rug on retail buying it when it goes public. But if the market suddenly enters a bear market, then it's going to be bad for their business because they're not going to be investing. I don't see interest rates going back up like we've seen in 2022. If that's the case, then okay, fine. Then it gets more expensive, capital is more expensive, fine. But if just the market goes down, what's the problem? I don't see, if your business is booming, you're doing extremely well, I don't see how a market pullback is going to hurt your business that much. Didn't hurt the other businesses in 2022, the good ones. They came out of it actually much, much stronger. Bit strange. Then with regards to the possible 23-hour trading day, I think it's a horrible idea. I think we need maybe less hours than more. I think it's a horrible idea. And if I need to make a prediction, I think a lot of people are going to be losing money and losing quite a lot of time as well. We don't need 23 hours trading day, 24 or 23/5 or whatnot. What we have today is already more than enough. But hey, if you can keep the casino open for longer, then you will be making more money, right? The Nasdaq and whatever, they're going to be making more money because the casino is basically open for a longer period of time. I just don't see the need for it. But that's just me. Why does it make sense, what he's saying? Or maybe probably not what I'm saying, but what he's saying. It just allows people to not have a life. If you're trading, you can just trade for longer during the day. You'll have way more volume because right now, yes, you do have pre-market, after-market, but it's not as liquid as when the market is open. But yeah, I don't think you need this. Brokers will love it. Yeah, brokers love this, but I don't think we need this. So that's Databricks. Again, whether or not they're going to go public next year, I sure hope they do. So we actually have another big company that we can compare to with the others. Then the big news, or the big other news that came out is this. Hut 8 inks a $7 billion AI data center lease backed by Google. So they sign a 15-year, $7 billion lease with Fluidstack for Louisiana AI campus. Google Alphabet provides financial backstop for lease obligations. Lease includes 3% annual escalator and 3 optional 5-year renewals. I do also think I saw an Anthropic deal, or maybe that's an extra one. I'm pretty sure I saw, because it's not, I saw an Anthropic one here. The deal covers 245 megawatts of IT capacity, right of first offer for another 1,000 megawatts more. Let me see. So Fluidstack, Google. So Anthropic and Fluid. So which one is it? Because look, here we're seeing people talk about Anthropic and Hut 8. Now it's only Fluidstack and Hut 8, but I assume they're partnering with Anthropic and Fluidstack to build between 245 megawatts and 2,295 megawatts. That's quite a big difference of AI data center capacity in the United States, starting with 245 megawatts of IT load backed by 330 megawatts of power at its Riverbend, Louisiana site. Anthropic also gets first right on another 1,000 megawatts. And that's why the stock was up quite significantly and still is up significantly. If we check that, I believe it's still up 19.2% at the moment on this announcement. So it is Anthropic, it is Google, it is Fluidstack. We've already seen, I think, Fluidstack and Google, right? I think so. Hot 8, Anthropic. And the 7 billion 15-year is almost like, if not the same as the CrowdStrike, CoreWeave Applied Digital one. Yeah, so it is Anthropic. It is Anthropic, it is Fluidstack as well. So why do people add Google to this thing? I assume Google has something to do with it. Let's see. I think that's the main reason why all the other neo clouds are also green at the moment, right? We're all talking about an AI bubble, and yet we are still seeing these types of deals, these types of companies wanting to invest and grow much, much faster. For those that are interested and invested in Vertiv, by the way, Vertiv will handle the engineering and infrastructure of the project. So for the Vertiv investor, that's how you get part of this deal. Okay, so Google's involvement here is they are going to back the payments. JP Morgan and Goldman Sachs financing construction. Okay, so that's their involvement here. Fluidstack will be the operator of the high-performance computer cluster that AI company Anthropic will use to train, run, and scale its LLMs. Voila, now we know how everyone plays a part here in this deal. Okay. Later today, yes, we do have Micron. Later today, we do have Micron. Now, before we jump into Micron, a little preview. We, of course, have Netflix. So Netflix is up 1.5% at the moment, and we do have some news on that.
Faber joins us right now from the New York Stock Exchange. He has that news. Good morning, David.
Good morning, Becky. We've been waiting for the response, so to speak, from Warner Brothers Discovery to that tender offer we got more than a week ago from Paramount to acquire Warner Brothers for $30 a share in cash. And we've gotten it this morning. It's a 14D9 filing. It is, as you might imagine, voluminous. That said, the key points are ones we've been making. And, of course, the lead is no thank you, Paramount, rejecting Paramount's latest bid, if you will, at $30 a share, all cash, for a variety of reasons, many of which we've been discussing over the last few days and over the last week or so as well. But let me get to specifics, because there are a number of them here, and they do focus, certainly at least starting with what they believe is being consistently misled by, that is, Paramount consistently misleading Warner Brothers shareholders that its proposed transaction has what they call a full backstop from the Ellison family. The Warner Brothers board of directors says it does not and never has. There is no Ellison family commitment of any kind. Instead, they propose that you rely on an unknown and opaque revocable trust for the certainty of this crucial deal funding. And they say, despite having been told repeatedly by Warner Brothers how important a full and unconditional financing commitment from the Ellison family was, and despite their own ample resources, of course, pointing to Larry Ellison's 1.1 billion shares of Oracle that are in that family trust, as well as multiple assurances during our strategic review process that such a commitment was forthcoming, the Ellison family has chosen not to backstop the Paramount offer. Now, of course, backstop is exactly the term that Paramount used in its latest bid, saying, in fact, the Ellison family is good for the roughly $8 billion or so in equity that they were going to need to complete the transaction. This is one of any number of specific recommendations / parts of the rejection that we've gotten this morning from Warner Brothers. They say they gave a full, transparent, and competitive review, established a level playing field that fostered a rigorous and fair process. Now, of course, Paramount has said nothing of the kind existed. In fact, that they feel as though they were disadvantaged, perhaps even from the start, but certainly later on when they felt as though their last offer didn't even get a response. They say, despite Paramount's media statements to the contrary, the board does not believe as well that there is material difference in regulatory risk between Paramount and Netflix. That's also very important, of course, as you both well know, given there has been a view that Paramount would have a speedier and easier regulatory review, certainly here in the United States, perhaps in Europe as well, than would putting together, as is the case, of course, with this merger agreement between Netflix and Warner Brothers, the number one streamer and the number 3 or 4 streaming, depending on how you measure things. But
well, it's not like I didn't say that this was going to happen, but I did. And Dr. E. James, I do believe there is a lot more of US, Qatari, and Saudis in this deal than anything else. So let's not try and put some conspiracy bullshit here in the comment section. But yeah, this deal makes a lot more sense between a Warner Brothers and a Netflix, because Netflix only wants of course, the IP, HBO, the studios. They don't need all the legacy business. And so their deal makes a lot more sense, especially to shareholders, for those that want to own the shares. For those that just want to get the cash and move on, then of course, just take your $30 and you're done. Because of course, $30 is more than $27.50. It makes sense. But purely from a value creation standpoint, a Warner Brothers Netflix combined business makes a hell of a lot more sense, I would say. And it's not like they're going to become suddenly super, super big. If you look at the current market share, YouTube is by far the biggest and growing quite quickly. Where is it? YouTube is quite big. Even if you add Netflix and Warner Brothers right now, you're not even getting to the levels of Netflix at the moment. Here, if we look at this is from November. Okay, still, I mean the most recent data. Streaming makes up 46.7% here. Of that 46.7%, you have 12.9% of YouTube, 8.3% Netflix, 4.7% Disney, 2.3% is Paramount, and 1.3% is Warner Brothers. They say Warner Brothers includes, so Warner Brothers Discovery includes viewing on Discovery Plus and Max. 1.3%. You add 1.3 to the 8.3 of Netflix, and you're not even getting to YouTube. So the whole monopoly thing doesn't make sense. Just because Netflix is, yes, I would say a household name, the most popular name, blah, 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 doesn't mean that they have 50% of the market. Again, in streaming, they're not the number one here. Yes, Warner Brothers, of course, I think the shareholders still need to vote. I think they'll vote in favor, because why not? Makes sense. Makes sense. You have Netflix, which again, Netflix has extremely good distribution. Then HBO, very good content in my opinion, great IP, probably one of the best out there. They have a great studio, legendary studio. But if you want distribution, I think Netflix could give you that. I think Netflix has, of course, the name, the amount of subscribers that they have. They could give the distribution and the attention to Warner Brothers, HBO, their content that maybe did not get as many eyeballs as previously expected. Netflix doesn't have a studio. Now they will have one with Warner Brothers. Paramount has a studio. So what are you going to combine two studios? People are going to lose their jobs. Are you going to compete with the two studios? How's that going to work? So from the start, this deal makes sense to me. I'm not a Netflix shareholder, as you know, but if I were to buy a new stock, it would be Netflix. But yeah, the deal makes sense. The deal makes sense. Now we're going to see how the stock will react. This morning, it's up 1.5%. But of course, it did drop when they announced the deal. And then it did drop even more when Paramount came in with their own deal. So we'll see if the stock can recover some of it, because the market was like, oh, we think Netflix goes down if they acquire it. And we also think Netflix goes down if they don't acquire it. So it's like a lose-lose situation. But again, we know, first of all, Netflix will start to have some user-generated content on the platform. YouTube has YouTube TV, YouTube streaming. I mean, it's all part of the same thing, which is the streaming market. At the end of the day, that's how you compete with each other. Because how can you then define if Netflix has a monopoly or not? Are you going to say, oh, it's only a monopoly because they are bigger than the other specific names in streaming? Or are you going to talk about the whole TV part? Right? Because essentially that's it. It's TV. Netflix is not, they have some live shows, but it's not live TV. But we're putting that in that big cake that I've shown you before, which is this one right here. Broadcast, streaming, other, and cable. People say that the other is probably the pirates, or maybe the pirates is coming here from the other streaming. But this is the big pie that you're playing for, right? All of the streaming players want to see their part grow and the others go down. And then inside of streaming, you have all of this competition. Netflix is in there. Disney is in there. Prime, YouTube, Roku, you name it. Netflix has been saying this for years, actually. They said their competition is not just Disney Plus or whatever. No, it is also YouTube. This is not something new to protect them from this acquisition. They've been saying this for quite a while. They've said that TikTok is, of course, one of their competitors, right? TikTok is also media, even gaming, because at the end of the day, they're all competing for the same thing, which is what are you going to watch on your screens? YouTube, Netflix, a movie, a reel, a TikTok, you name it. Then I see, again, the whole thing about this CNN stuff. If CNN is failing, then it's failing for a reason. I don't think anyone should come or be forced to buy a failing business or asset, right? If the business is failing, there's a reason why. People are just not watching it anymore because probably it sucks, right? I mean, they even have their BS fear and greed indicator that doesn't make any sense. So forcing someone to buy CNN because it's part of this other company, to me, doesn't make any sense. If it's a failing business, let it fail and let the public choose what they want to watch instead, which I think is how a free market should work. Then, okay, quickly touching again on the Hut 8 deal, because Thomas didn't understand. It's basically what we've seen with some other companies out there. It's literally AI companies, AI lab studios that want to move faster, so they go to these types of companies. Previously, I think Hut 8 was a Bitcoin miner before. They've got the infrastructure, they've got the megawatts, and so they're going to them. We want to have what you have. This is the amount of money. These are our partners. Fluid Stack, we have Google financing. We have a Vertiv that will come in and help us as well. So that's basically the deal here. Starts very small, could potentially be worth a hell of a lot more money if they really go to the 2,295 megawatts. Right now it's 245 megawatts, so quite a big difference between the two figures here. Then we do have a comment on PayPal, believe it or not, and it's actually not a negative one for once. I know, I'm as surprised as you. So we have here a PayPal note from Bernstein, reiterates market perform and maintains a $76 price target. Poof. Who knew? Charter, they already talk about the charter. I think it's a bit too early to say that. Charter could improve lending economics and processing cost structure, enable more control via reduced reliance on partner banks, supports potential move into banking high yield savings, what we said yesterday. At 11 times PE, Charter is not multiple dilutive. Market focus remains on branded biz trend, but analysts watching lending, Venmo, SMB initiatives. I think this is the first non-negative note we've got about on PayPal in a long time. A long time, actually. Did that move the stock? Probably not. But then again, most of the fintechs are green at the moment, other than new holdings. That's down a little bit. PayPal is up 0.4%. So let's see. Let's see here if we got something on new. Maybe also a price. No. Don't see anything on new holdings at the moment. Let's see if Mercado Libre is also down. Because they usually, if one is down, the other one follows. If one is up. No, Meli is flat at the moment. Novo is also down 1.9. Nvidia is down 0.2. United Health is, let's call it flat. All the rest on the list here is green at the moment. Last thing before we go and have a quick overview of Micron for later today. Got some comments here from RBC on 2026 and their expectations. QNC, thanks for the super chat. What did I buy this week? I bought a bit more of Uber, Nebius, and Shift4, and I did also add 50 shares of Iron yesterday. That's what I did for now. But again, it doesn't matter. It doesn't matter what you think. They're both playing in the same market. And that's what's important. Whether Hollywood has a narrative or it doesn't matter. It's content, it's streaming, it's on TV. They are competitors. And when they are competitors, you cannot claim that a smaller player is bigger than the bigger player, because the data literally shows that YouTube has the bigger chunk here. Now, moving towards next year. We've already had a couple of analysts talk about what they expect for next year. A lot of them that we did cover did see 9-10% growth for the S&P.
Right now in the markets is Lori Calvasina. She is RBC Capital Markets Head of U.S. Equity Strategy Research. We're already looking at 2026. Things have been pretty great this year for the markets, even though it was kind of a scary ride up. You had the April situation with the tariffs that spooked everybody, and it's been kind of a fought upside battle since then.
Right, it's been a roller coaster. I mean, and while roller coasters can often be fun for some people, not for me, frankly, you don't necessarily feel great when you're sort of sitting at the top of the next hill. And it's interesting.
Is that where you think we are right now?
I think we're going to have a good year. I mean, frankly, this 5% drawdown we had in the a month or so ago, I wish it had been a little bit more, just to get a little bit more of the froth out. There's still a lot of angst out there. I keep using the word, well, we have to be vigilant on this, we have to be vigilant on that. But at the end of the day, I do think we're going to have a good year next year. So we've got a 12-month price target on the S&P of 77.50.
Wow.
At the time we put that out, right around Thanksgiving, I think December 1st we put it out. it was a 14% gain, right? So we've rallied back. That return has come down a bit. But as I talk to people, I keep saying, look, we could still have some indigestion, even getting a 5 to 10% drawdown at some point next year. I still think we can make our 7750 number. Our modeling goes all the way from 7,200 on the more conservative end when we bake in GDP forecasts. When we do our valuation earnings work, we can get you all the way up to 8,000.
Well, that's what I was going to say. Earnings, just watching the earnings that have been coming in.
Did she just say 8,000?
But at the end of the day, I do think we're going to have a good year next year. So we've got a 12-month price target on the S&P of 7750. Wow. At the time we put that out, right around Thanksgiving, I think December 1st we put it out, it was a 14% gain, right? So we've rallied back. That return has come down a bit. But as I talk to people, I keep saying, look, we could still have some indigestion, even getting a 5 to 10% drawdown at some point next year. I still think we can make our 7750 number. Our modeling goes all the way from 7,200 on the more conservative end when we bake in GDP forecasts. When we do our valuation earnings work, we can get you all the way up to 8,000.
Well, that's what I was going to say. Earnings,
okay, so
just watching the earnings
case,
that have been coming in and what you expect from here.
So the bottom-up consensus, which frankly I think is the best way to do it, because I think you have to do this work stock by stock. Macro-wise, we can't tell you what's going to happen in tech margins or biotech margins. And the reality is 13% earnings growth is not that heroic. A 14% return right on top of that, that's actually telling you there's not going to be a lot of multiple expansion, right? That we're going to really be queuing off this earnings environment. And, we're still seeing some good numbers. If you look at the rates of upward revisions, they're not as strong as they were over the summer, but we're still getting some healthy moves there. And what's really interesting, Becky, there's so much angst on this AI trade. But people are saying, I want to look at cheap sectors. I want to look at where AI can enhance productivity down the road. So let's maybe talk about things like healthcare. So people are nervous. They're in risk management mode, but they're also thinking constructively.
Smart and good answers indeed. For once, it's not about blah, 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 stupid stuff in the air. I agree. I actually agree with her. I think, again, next year, you are going to see various sectors. And we're seeing more and more comments on this whole AI is profitable for a lot of companies, or they see a path to profitability already starting in 2026 because they've invested in their tech for the company and it is making their employees more productive. And so it makes sense that the business as a whole becomes more profitable. I like this lady.
The AI returns for all of these other sectors, does that actually pay off in 2026? Does it lead straight to the bottom line with earnings?
I think that we are still very early days. I was pleasantly surprised towards the end of this last reporting season that I was actually seeing a few companies in the consumer space actually put out some hard numbers on, say, we had this fulfillment center, we used AI on that, we increased productivity by 30%. Again, very early days, but at least we're starting to get some tangible pointers from companies.
Which consumer companies were the ones that kind of jumped out with that? Where did you hear it?
I can't get into individual companies, but it was more on sort of the retail side. Okay. And what was interesting is that my team and I, we read transcripts really, really closely. And as we've gone back over the past years, we've seen things like, a chat bot, right, from like a travel company, things that frankly felt a little bit underwhelming to us. Yeah. As we looked kind of in the middle of the year, we felt like business services type companies, that really had kind of deep roots in the tech space were giving us some tangible examples, even if they weren't giving specific numbers.
You mean like replacing call centers type of things?
Replacing call centers. I mean, I will tell you, we see a lot of references to productivities, efficiencies, those sorts of things. But it does feel to me like companies that are a little bit more deeper in the tech world, even if they're not tech companies per se, have done a better job of sort of sounding real, to be honest, when they've had, some of these impacts.
Yeah, I mean, it's one thing to say AI 72 times on a conference call. It's another thing to lay out a clear-cut example where you are seeing efficiencies.
And look, I think that's part of the jitters, right? I spend probably more of my time talking to long-only investors than hedge funds. I have a healthy amount of the latter. But as I went through the summer, I felt like not only were long-only investors, we were sort of talking about what we were hearing on the earnings calls and the companies, but also just in terms of their own day-to-day use cases, right? And I think the idea that a lot of this is still sort of in an experimental phase, we're still figuring out the use cases. I think a lot of people in the investment community have been living that in their day-to-day life. And so then when you also, sort of translate that to the returns you're getting from companies, this idea that this was all going to be transformational tomorrow, I just think for a lot of companies and industries, it hasn't panned out yet. Some it has, right? It's very hard to draw a broad brush, but there was a lot of impatience with this trade from early on. And I think what investors are learning now is you have to be a little bit more patient and give it a little bit more time.
Very quickly.
This lady should be on CNBC a lot more, a hell of a lot more than a lot of the other guests that they have on, because she knows what to say. She's quite smart, quite smart. I mean, she literally says what we've all been saying. Patience, right? It's too early to conclude and say, oh, that there's no good return on investment. They're all overspending. Nobody's seeing good results. Everybody's losing money and blah, 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 blah. I think what she's saying is quite correct. Quite correct. Jason, so going back to your main point, to this point. In terms of content creation, Netflix is far more dominant than either Disney or the rest of the five combined. Do we say that Netflix's IP is better and has a larger library than Disney? Because I don't think that's correct. I mean, have we seen what Disney as a whole owns? Pixar, Marvel, Star Wars. I mean, the whole Fox acquisition. Why didn't they stop that? Right? Because if Disney themselves was allowed to buy Fox, why wouldn't Netflix be able to buy Warner Brothers? Unless, of course, you think Disney should not have been allowed to buy Fox, then you're making the same case here. Although I do still think that Disney is much bigger than a Netflix. I appreciate the comment, and the beauty of this thing is that you don't have to agree with me on everything. That's why things are my portfolio and things are in your portfolio. I might not agree with you either on some position in your portfolio, but it doesn't matter. It doesn't matter, because you invest for yourself, I invest for myself. I do what's best for me, you do what's best for you. Sometimes we'll agree, hopefully most of the times we agree, and some of the times we disagree, and that's completely fine. Completely fine. Yeah, maybe we should get this lady on the channel. Maybe we should. Do we have a date for the Supreme decision? I don't think so, but from what we've heard yesterday, it's supposed to be early January. From what we've heard yesterday. Correct, but that's just because the market likes the business performance of Netflix and not that of Disney, purely if you look at free cash flow margin and all of that. But Disney as a whole, I mean, if you look at their IP, their portfolio, the Disney parks and everything, you cannot tell me that is not a huge thing to have, and probably much bigger than what Netflix has, which is just a streaming platform. But yes, market cap, there is a difference. But then again, probably, I mean, when they did acquire Fox, I do think it was a bad acquisition, which they overpaid, because Netflix is doing what Disney should have done, which is acquiring only the things they are going to need to grow the streaming side of things. None of the unprofitable legacy systems. That's it. Netflix certainly grabs more attention than Disney. Yeah, again, yes and no. Yes and no. You're talking, yes, K-pop Demon Hunter, a good hit. Squid Game Season 1, a good hit. But those are hits. Those are hits. And we only talk about the hits. How many misses? A hell of a lot of misses. Disney is still Disney. Avatar is coming out, what is it, today or I think today or this, yeah, probably this week, Avatar. It's owned by Disney. The whole, I mean, everything that Fox had, it's all Disney. Star Wars, as much as it sucks, right now? It's all Disney, Marvel, not the semiconductor, Marvel, the superhero franchises. It's all Disney. So again, Disney has the IP. They might not have the great success as of now, but their direct-to-consumer business is becoming more and more profitable. And I don't think you will be able to say, oh, Netflix is still like the monopoly there. I don't think Netflix is a monopoly. Fact of the matter is there are way more streaming players today than there were at the start of this whole streaming wars. And they're all growing. Some of them are becoming more and more profitable. But yeah, I don't know. To me, it's a no-brainer to let this deal go through. But I don't decide. What's her name? Her name is Lori Calvasina. We have 4 minutes until the market opens. So quickly now, looking at Micron. Micron will report later today. I won't stream it, but I'll probably cover it in a video. So Micron right now, $236, $260 billion in market cap. Market is expecting the following: revenue of $12.88 billion, EPS of $3.94, and for the quarter after that, $4.48, and free cash flow of around $1.11 billion. Actually, let's have a look at revenue the quarter after that. That's 14.22. So tonight or later today for some of you, 12.88 billion in revenue, then 14.22 billion dollars in revenue the quarter after that, if they were, of course, to give us the guidance. So that's for Micron. The last time they did give us some information was a month ago. So they told us that HBM is fully contracted for calendar 2026, encompassing both HBM3E and HBM4. DRAM inventory levels are currently below target, while NAND inventory is improving and expected to be near target levels by the end of fiscal 26. Gross margins are projected to be stronger in the second quarter than in the first quarter, continuing a positive trend. Debt has been reduced from approximately $16 billion to below $12 billion, with an expectations to achieve a net cash position in the near term. A $300 share repurchase authorized under the CHIPS definitive agreement was completed this quarter. So I do still expect to hear quite a lot of positive comments on HBM. Again, we already know that it's fully contracted for calendar 2026. Let's see if we get some positive comments on HBM4E. And then, yeah, some more color on this. They did say that they anticipate the current market tightness that will persist beyond 2026, driven by strong AI demand and limited industry supply. The company's HBM supply is fully contracted for calendar 2026, including both HBM3E and HBM4. So again, I do still expect a good earnings report by Micron, but as we've seen in the last couple of weeks, good earnings report might not be good enough for the market. I took some profits 2 days ago, still hold a decent position, I think. So I think we're going to do well later today. As a business, comments should be strong for Micron. And now let's go and open the markets. Voila. Almost open. Couple of seconds. And then we'll see if we keep all the green or if green turns into red. Yesterday was a strange day. Although we did see some names improve yesterday. I mean, Nebuset, I think 10 minutes before the close was break even. Break even was basically flat. Ended the day down 0.23%. We'll see what happens today. As of now, it looks fine pre-market, but we'll see right now, ladies and gents. Ding, 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 bing, bing, bong, bing, bong. Markets are open. It is Wednesday, December 17. Markets are open. And so, what do we see across the board? We are seeing a lot more green than red, but let's not get fooled. Let's not get fooled because we know what has happened before, right? We know what has happened before. I already see a couple of names that were green pre-market that are now reddish, a little bit of red at the moment. So we'll see. Disney was break even this quarter. You're talking about their DTC business because Disney as a whole has been, I mean, they're expecting $10 billion in free cash flow for the year. So again, the arguments that you're making here don't make sense to me because Disney is Disney, Netflix is Netflix. In my opinion, Disney owns a hell of a lot more than Netflix. The business is becoming more and more profitable. I'll show you. I'll show you in a bit the free cash flow transformation of the business, and they expect that to continue into next year. And fact of the matter is, Disney was allowed to buy Fox. All right. Let's see. Fintech names. We have PayPal, which is flat. PayPal was green pre-market. Now it's flat. Nu is down 0.9%. Cesar was also green, now down 0.3%. Adyen is down 0.6%. MasterCard's basically flat. Klarna as well. Then who's up the most? We have Pagaya, that's up 4.2%. I mean, Pagaya took a 9%. The heat map is much better now. Pagaya was down, I think, 9% on Friday, another 10% or so on Monday. So being up right now 4.7% doesn't really do that much, but fine, we'll take it. dLocal up 3.6%. Someone told me in the chat that they got a price target upgrade, I believe. Hood is up 2.3% after yesterday's event. Affirm continues to be green also after yesterday's announcement of maybe another agreement with Amazon. Dave is up 1.3%, Block is up 1%, Bull is up 1.5%, Chime 1.1%, SoFi 0.7%. So Kyle, Stockgoat, you don't have to shave your eyebrows just yet. American Express up 0.7%, same for Shift4, Visa and PayPal is flat. As for the neoclouds, we have Hut 8 up 16%, Cypher up 5%, Nebius 1.5%, Applied 1%, White Fiber 2%, and Iron, let's call it 1%, and CoreWeave is down 0.4%, so literally not getting any love. I did try to get Jose on the stream today, but he does not have the time today. Nvidia is down 1.6%, ASML 1.2%, Broadcom 0.2%. Then we have green names. We have Marvell up 2.3%, Micron 1.5%, Intel 1%, Qualcomm 0.4%, same for Lam, CLAC, AMD, Applied Material, and TSM is up 0.1%. Big Tech, Netflix is up 2.6%, Amazon 1.1%, Google down 0.4%, Apple is up 0.4%, Microsoft up 0.2%, Meta up 0.3%, Tesla is up 1%, and Oracle is down 3% on that Blue Owl announcement from before. Quickly showing you the free cash flow transformation here. And then we'll look at some specific names and charts. If you have some specific names you want me to go over, let me know in the chat below. So yeah. So this is Disney free cash flow wise. I believe this was here a one-time thing that happened, but last quarter $2.5 billion free cash flow. Next quarter same thing after that. So free cash flow wise, it is not an issue if you look at annually. We are here Fiscal 26, market is expecting 9.7. The company is expecting $10 billion. Then it's another $10.3 billion the fiscal year after that, and another $10 billion the year after that. So free cash flow wise, for the next three, let's call it, including this one, it's over $30 billion in free cash flow for Disney. So you can clearly see a turnaround that has happened here for the company, which of course is a reason why they are paying you a dividend and are again buying back some shares. Entertainment operating income. I mean, entertainment operating income, December is usually the best quarter, so that's the one that's happening right now. It's also been profitable here for a while. Let's see. DTC business, approximately 195 million global subscribers. So yeah, here, fiscal 26 free cash flow guidance of $10 billion, including $9 billion in capex. Dividend has increased by 50%, and share repurchases are doubling to $7 billion. Not bad, I would say. All right, looking at some other names here. We have Melly, that's up 0.64% at the moment. CRM is up 1.6%. Reddit is up 2.6%. Shopify 2.7%. Uber is still down, so Uber is still not getting any love at the moment from the market. I think they're wrong, and I think the market will prove me right next year or in the next couple of weeks. CoreWeave is down 1.8%, so getting worse for them. Well, getting worse for a lot of the neo cloud players. A lot of them are starting to turn a little bit red. Rubrik is down another 2%, getting closer actually on that 50-day moving average. If it goes even lower towards the 70, I'll be a buyer there. Why is it dropping? That's a good question. I did see, I think, a note. Let's see if I can find it. Rubrik. We did see a note here. Yeah, so nothing has changed, I think, from their price target. Just they maintained an overweight rating, Cantor Fitzgerald, after strong Q3 beat, and that makes sense. Why are we seeing this pullback? I don't know, but if the market forces me to buy more shares, then I guess I'll do it. Did I freeze? I don't think I froze. Really? At this time, I didn't see anything on my screen. I mean, I saw myself talking. So where did I cut off? Or maybe it's not for everyone, I don't know. Because the first one, my screen was basically black. So yeah. I froze twice. Well, for some strange reason, for me, I see that I'm still live. So apologies for that. But anyways, Rubrik, why is there a pullback? I don't know. But if the market forces me to buy the stock, I mean, more shares, it's now down 17.5% from the peak. Still has some ways to go to completely fill that gap. I forgot to close the poll. Yeah, but I checked 5 minutes before, and it didn't really change much. So 61% of you say green, 26 say red, 13 say flat for today. Yeah, Rubrik was up. I mean, Rubrik was up after the earnings report, 20% or so, and it went all the way to $92, $93. And now we're down. Now I would say 18% or so. So more than halfway through the gap up after earnings. Very, very good earnings report. Again, double beat and guidance was raised. What more can you ask from the company? Not a lot, I would say. And PayPal is a red indeed, but as you can see, we are seeing a hell of a lot more red now than at the start of the day. If we go back here, so big tech, nothing much has changed from the start. Chips, we are also seeing here a bit more red. AMD joined the red. TSM, Applied Material, now Intel and Lam Research. Neoclouds, HUT is still up 16.5%. Cypher is up 2.3%. White Fiber is up 2%. But then we have Nebius that's down 0.6%. Iron is down 0.8%. Applied 1.1%. And CoreWeave is down yet again 3.1% here. As for the fintech names, we still have here, Pagaya is now just above that 200-day moving average. So a bit of the same trend as before. Goes down, stays down for a day or two, and then went back up. We'll see what happens there. D-Local up almost 3%. I think we had someone told me we had a comment from D-Local. Yeah, tomorrow, exactly. Tomorrow we have a CPI, and triple witching is Thursday, Friday. So we can check the VIX in a bit, because I assume we were going to check the VIX tomorrow and Friday as well, because I think it's going to have some fun. But I can't find anything on D-Local, but someone said I think a price target of 21 was mentioned. So VIX, yesterday, no, nothing, still here for now, 16.5 at the moment. Shift 4 is up 1.3. PayPal is flat, so that's fine. That's fine. Who's down the most today is still the CoreWeave. CoreWeave doesn't get any love from the market. Do we see something here? No, not really. Not really. Then we have Rubrik down, Nvidia down 2%. Okay, even Google is down 2%. Oscar is down 1.8. I believe it's from because of yesterday as well. The AC enhanced subsidy vote, right, did not go through. Are we surprised? Probably not. Yeah, no, it's rarely the best of the best ideas to buy pre-market unless it's deep red. If it's deep red and you think it's an overreaction, then sometimes it does make some sense. But when it's green, the pre-market green is a sneaky one. Sneaky one. Yeah, I saw this from yesterday. So D-Local announced a new strategic partnership with Convera, a global leader in commercial payments. So that was announced yesterday. They'll start in Colombia and expand across Africa, Asia, and Latin America. I agree. I think I might add some. Yeah, I think I might add some shares because I did add already to Nebius and Iron. So would be a shame to leave CoreWeave out of the equation here. I don't want to play the options game here with CoreWeave, but just adding shares might be a good idea. Yesterday I bought just an extra 50 shares of Irons, not the craziest of moves, but yeah, CoreWeave could be a good idea for me to add. I mean, if this is again a bottom like we've seen before, could see a strong reversal as suddenly the market starts to understand that the backlog for CoreWeave is still immense, $55 billion, $5 billion in revenue for this year. Yes, there was a delay. It is CapEx heavy, but a lot of the deals are, these are five to sometimes 6 years contracts. So yeah. Oh, with Nebius, we also had some news actually for today. It's not a deal announcement or something, just a pure business announcement from Nebius. So they've announced Nebius AI Cloud 3.1, by the way. Manuel Cunha here, great follow on X. So Nebius is now the first cloud provider in Europe running GB300's NVLink 72 systems in production and the first globally to operate them on 800 gigabits per second NVIDIA Quantum X800 InfiniBand batteries not included. It's like these commercials where they say everything, the disclaimer super quickly. Effectively doubling throughput for large-scale distributed training and inference. Continues by saying, if you want to read the whole thing, just go on his profile or on Nebius's website. But the most important thing, again, is a reminder, is this one. Nebius is a production-grade AI cloud provider, not a raw compute reseller, and is purpose-built for AI at enterprise scale. That is the main reason, or one of the main reasons why I am so bullish on Nebius, why I chose this one as the neo cloud player for me on top of the Iron and CoreWeave. I do think that if we're looking for the AWS of AI, I think Nebius fits that bill. As I say this, it is down 2.5%. Yes. I mean, it could fill the gap, although it needs to go down another 13-14% to completely fill that Microsoft gap up, or it can just rebound here. We've seen it rebound here at these levels because it was previously a resistance. Previously it did rebound here. Not all gaps get filled, but most of them do. And if we do go under $70, I will I will take advantage of it. So yeah, this is the usual thing we've seen recently. It's a very green pre-market, market opens and paf, everything goes down. It's dropping. I mean, if you notice, it's not the only thing dropping today. But yesterday was the news that came out right from the ACA enhanced subsidy vote thing for the extension. It didn't happen, and so market is reacting. But again, for me in the long run, Oscar is focused on ICRA, and let's say the ACA marketplace is still going to exist, just the enhanced subsidies will not be extended. They are already quite prepared for 2026, even without the subsidies being extended. So they're still believing in the 2026 being a return to profitability. To me, that's good. That's good enough. And yes, in the meantime, it's going to be a volatile stock for now. This is taking, okay, so we are seeing pullbacks even from, I mean, even the Duolingo is green today, 2.3. It's like the upside down. Upside down, that's next week. Final part of the seasons. PayPal is actually up a little bit at the moment. United Health is again flat. I do think that 2026, I mean, EPS for them is going to grow. 2027 is going to be even better. 2026 is maybe a year if you don't want to have too much exposure to AI. Healthcare names could definitely help your portfolio, I guess, balance things out a little bit. Biotech is still risky because a lot of biotech companies are just not profitable right now. They're working towards solutions in the future that would be maybe making them quite a lot of revenue, but it's a bit more on the riskier side. I think financials will do quite well next year. And AI as a whole, if I didn't believe that AI would continue to grow and do well, or tech, because everything has been rebranded to AI, which is very annoying. A lot of the AI products are it's just software as a service, okay? It's just been rebranded with AI. It's just a pure marketing thing, if we're being completely honest here. Novo Nordisk, yeah, I mean, but Novo Nordisk, I'll put it in the same camp as a Netflix, as a Nike. I'll explain. Complete different companies, I know, but new CEO coming in, huge company, turnaround story. So it's going to take a while. In the meantime, I do think you're getting a nice dividend from Novo Nordisk, right? What is it? Novo is paying, let's see. I think it was 4%. So if you're interested in that, I guess you get that. But it is a turnaround story that will also take some time. Remember, the stock previously was cheaper than today, despite the stock being down. It's purely because the guidance was revised on the downside. So previously, you were looking at a company that was supposed to grow faster than what it is today. So that's Novo. What else? Moderna, I know some people talk about that. Maybe Pfizer, right? Pfizer as well. It's also a dividend type of play. Moderna, if you want to have that. This one, nice rebound. These types of names I've seen pop up. Or, I mean, semi-defensive, but not really. It's Amazon. Amazon at these prices, not the craziest thing. Mercado Libre at these prices, not the craziest thing either. Yes, you are still exposed to AI, tech, e-commerce, but these are great companies. These are great companies. You can always have, add, if you need in your portfolio, a couple of names that are not connected to AI, although as you can see, the market sometimes just pulls everything down, regardless if they are AI or not. But if you feel more comfortable owning players outside the tech AI sectors, then yeah, maybe do it. You have to do what's best for you. You have to do what's best for you, what's best for your portfolio. Every move that you make should be made to optimize the performance of the portfolio and to make sure that you don't feel bad or you lose sleep at night because XYZ has happened. I will say time and time again, I think controlling emotions is one of the biggest advantages that you can have as an investor. If you're good at controlling your emotions, you are probably going to do a hell of a lot better than a lot of investors that are extremely emotional about their holdings and their portfolio. Because when you are emotional, you are making stupid decisions most of the times. It's the same with the casino, right? If you play, let's say at the table, blackjack, poof, you have 9, dealer has 6. What do? You double up, right? Double up. What do you get from your 9? Let's say you get 18, or even better, you get a 10, poof, 19. The dealer has a 6, worst hand for the dealer, right? Better odds for you. Dealer flips, boom, 10, next card, an ace, 21, you're done. What happens in someone's head is like, God damn it, should have won this, should have doubled more than doubled my money. Screw this, I'm going in again, $200. Stupid emotional reaction, because chances are you are going to lose the next $200 as well. Does that mean you should stop crying? No crying in the casino, you know? No crying in the casino. CEO board, including do so from Amazon. Okay, I thought it was a question. Another stock that a lot of you have talked about is a Credo, and I've seen that Credo also had a big pullback from the post-earning reaction. It's actually down 34%. Credo, down 34% at the moment, which I know who owns. Okay, Daniel, I've seen your Birkenstock comment. So Birken. Okay, what happened? Earnings tomorrow morning apparently. Why is this thing up so much in recent weeks? 23%. I guess we've seen the same reaction from what is it? Abercrombie. It's also up significantly since. What has Crocs been doing? Also, so it seems these types of names have all followed in the same direction. It's the opposite of neoclouds. Neoclouds stopped. They all went down the same pattern. Seems like Birkenstock, Crocs, Abercrombie, American Eagle all went up at the same time. But yeah, people that own Credo what has happened? What do you think is the reason for this? And have I seen the film Go? No, I've not. Go, that's the title of the movie? $19.99. No, I have not. Alkaj, what do you think about Ferrari? Decent price for quality company. I think it's never going to be cheap. That's the thing with Ferrari. It's never going to be cheap. It's an expensive stock, just less expensive today. Is this the best name that we can see in the market today? Probably not. But yeah, you're now trading at levels that you've not seen since end of 23, start of 24. There is a gap here, all the way to 355. Did it actually reach it? I did sort of close it. It's quality business, but do I need it? Probably not. Probably not. Pourquoi in the hell is Grab down below $4.9? What did they do wrong? A lot of the times they don't do, a lot of the time stocks don't do anything wrong. It's just the market that pulls them down for no reason. It is, again, at the same level as the end of, we've seen this pattern with so many stocks. They're just back at their bottom of 3 weeks ago. If we do get a double bottom, I do think it's a good sign. Actually, I was 5. I was 5 in 1999, but it doesn't matter. One of my favorite movies of all time is One Flew Over the Cuckoo's Nest, and I wasn't born. I wasn't even in production back then, because that movie was, I think, in 1975 or something like that. So yeah. But in 1994, Lion King came out. It's one of the best Disney movies out there. Duel. Great movie. Super simple movie, but a great movie. Very, very good movie. I saw this one as well. Actually, I saw this one a long time ago. Very long time ago, but I like it. Thanks for the super chat. Top 3 buys at current levels. Well, I bought yesterday, what did I buy? 2 days ago. I bought some Uber, bought some Shift4, so I have to include those, maybe a Nebius, a PayPal, as always. But yeah, the list can go on and on, but you want top 3. It's difficult for me to say top 3. So top 3 for me right now, what I'm looking to maybe add, I'll probably add a little bit of CoreWeave. For me personally, I'll add a little bit of CoreWeave. Well, I would include Uber, but I just bought more Uber, but I'll include that as well. Anyways, doesn't matter. And yeah, Shift4 or Nebius for me, I'll add there if I had to choose. But if I have to make a general list, it's yes, Duel was indeed his first film, very good one. Amazon to me is a no-brainer at these levels. What else do we see here on the list? Uber is below $80 right now. Yeah, I mean, even dLocal, it's up 3% today, but it's still not expensive. This was terrible. This was terrible. Apologies for that. But anyways, we'll have to... It's probably because my VPN was still on. That is stupid. Okay, I'm not going to turn it off right now because it's going to turn off my stream yet again. So yeah, anyways, maybe it's a sign that we have to close the stream and go outside a little bit. But what did I want to say? I was just about to talk about Citizen Kane. It is, why do I use a VPN? For cybersecurity reason, when I want to upload my articles to the Motley Fool, we have to use it. Otherwise, we cannot use the website. So that's the reason why. But I usually turn it off during the stream because then it doesn't screw up my my stream and my connection with the servers. Citizen Kane is it's one of those movies that you always hear people talk about as one of the greatest movies of all times, but started watching this and I didn't like it. I didn't like it at all. So yeah, that's that. All in all, the market seems to not... it's mixed, but it was much better. It was much better. I mean, even the neo clouds were bright green pre-market. Some of them are still bright green, HUT, Cypher, and White Fiber. Fintechs, most of them are green, so that's fine. As long as PayPal stays green, we're good to go. And ships names are also mostly red. Some of them are green, but that's about it. Big tech is the same as before. Rubrik is down 3.3, Nu 2.4, AST2, Nebius down to, Uber is below 80. I think it's a steal unless they suddenly explode, but I don't think that's going to happen. I think 26 Uber will show Wall Street that they've got their fingers in so many autonomous vehicle companies that it's going to be quite fine for them. Zeta is down 1.1, so just below 18. Sezzle is down 1.8. Oscar is down 1. Melli is down 1.2 now. So, 1900 for Melli. Okay. Okay. Interesting. The Good, the Bad, and the Ugly. Yeah. It is also one of those classics. Clint Eastwood has some... Gran Torino is a very good movie from him. There are a lot of movies where he directed and I didn't know he was the director. Where is my Santa rally? I don't know. I asked this question as well. I don't know. It's the Grinch. He stole Christmas. But then again, we can still have one starting tomorrow or Friday or maybe next Monday, going into the end of the year. But for now, we do not get it. Let's quickly have a look again. Government shutdown is now at 39% for the end of January, and the probability of a rate cut jumped to 24.4% for January as well. Other than that, everything still remains the same, still no Santa rally, still a huge overreaction, in my opinion, on this whole AI story. We do have Micron later today. I think memory is doing quite well. I'll comment on it probably in a video recapping the earnings report. I did check this company out a couple of months ago. Interesting, but not as interesting for me. I know the track record of Brad Jacobs is very good. He's done that with other companies as well. I think is it QXO or another one that bought the roofing company, right? If I remember correctly. So interesting, but not as interesting for me. So yeah, I'm going to end it by saying iron is green, White Fiber is green, Cypher is green, Hut 8 is up 18%, and even PayPal is up 1.3%. We'll leave it at that. Ladies and gentlemen, that's good enough for now. I shall be back later today, probably with a video talking a little bit about Micron and some other stuff, and then we'll be back tomorrow morning for another breakfast stream. Thank you all for joining. Really appreciate it. Carlos Alcaraz split up with Juan Carlos Ferrero. Breaking news. I don't know why he did it. I have my opinion. I think Alcaraz wants to be more of a celebrity. Juan Carlos Ferrero wants to focus a lot more on tennis. Carlito doesn't like it. And the relationship is over. All right. That's about it for me. See you all in the next one. Bye-bye.